Yeah, good morning. This chilled Saturday morning of the 10th of June 2023. You are highly welcome to the first class of this session. We are taking you Professional Transition 2, and the course title is Tax Audit and Investigation. Tax Audit and Investigation. And my name is Cletus Itachot, who will be your anchor person in this course. But we will be having two facilitators taking the course interchangeably. But for this first session, I will set the ball rolling. So if you are hearing me loud and clear, can you also signify by just making a hi, let other people know that you are there. A hi and your name and a hi, or any other thing you want to add. So let's quickly do that before we move on.
Hello, good morning. My name is Rafi Wafalabi in Lagos. I can hear you loud and clear. Thank you for having us.
Okay, right.
Hello, good morning.
Me?
My name is Odumade from Warri. I can hear you loud and clear. Thank you.
Your name is Odumade, Abi? Okay.
Yes, Odumade from Warri, Delta State.
Okay, all right. You are welcome from Delta.
Thank you.
Hi, my name is Grace Johnson, and I'm joining from Abuja. I can hear you loud and clear.
Wow, welcome, Grace Johnson. Good morning to you. More join us.
Okay, my name is Ambrosia, joined from Abuja.
Ambrosia, okay. Welcome.
Yeah, thank you.
Where is Mubarak joining from? Mubarak, are you hearing me loud and clear? Okay. Seems Mubarak is not hearing me. All right, let's move ahead. As I said, this is Professional Transition 2, Tax Audit and Investigation. My name is Cletus Itachot. I'll be your anchor person in this course. So course description is that you as a student, the course is designed for you as a student, and this course covers the audit of all the variables in income statement. All the variables in income statement. When you talk of all the variables, you are talking about income, revenue, cost of sales, administrative expenses, finance costs, personal expenses, gross profit, net profit, taxation. So it has to do with variables in income statement, balance sheet. The balance sheet, you talk of the PPE, property, plant and equipment, talk of non-current assets, where you have cash and cash equivalents. You have inventories and receivables and so on. And you talk of liabilities and equity. Those are variables in the balance sheet. Then cash flow statements also. Then you are also to identify tax audit risk. This is what this course is all about. You have to identify tax audit risk issue tax audit risk issue, and risk assessment. How can you assess risk? It also covers the investigation of fraud. You can see the title of the course is Tax Audit and Investigation. So investigation is part and parcel of it. Then error of omission of commission and intentional manipulation of variables in order to lessen the taxpayer's tax liability. Then candidate must have prerequisite knowledge of principles of taxation, principle of taxation, sorry for the disruption. I was saying that the course also covers investigation of fraud. That is fraud in terms of tax fraud and all those stuff. Error of omission or commission and intentional manipulation of variables in order to lessen the tax liability. The candidate must have prerequisite knowledge of principle of taxation and financial accounting at foundation level. So financial accounting is a course at foundation, and also principle of taxation. So levels as well as practice of income and indirect taxation. There's a course called income tax and indirect tax. So there are also courses in I think professional 2 or professional 1. Then an income tax for specialized businesses. This income tax for specialized businesses is another course in professional 2. So we are mentioning the courses that are intertwined, that are linked to this course that you need to know. So before we proceed, what variables do you think that a taxpayer can lessen? A taxpayer can lessen its tax liability. What are the variables that you think a taxpayer can lessen its tax liability? They are hearing me. You can unmute and speak. I like interaction class, except I'm the only one talking in the class, except there's no student. But if there's students, you must say something. The student in the class. Can you get my question? Hello, are we there?
Yes, please.
Did you get my question? Did you get my question, Claire? Talk to me.
You said how can a taxpayer lessen tax liability?
Yes, I said, what are the variables? What are the variables that the taxpayer will use to lessen tax liability? What are the variables? We have talked about balance sheets, cash flow, statements, income statements, and we have mentioned the variables in all these accounts. So what are those variables? How can he use these variables to lessen his tax liability? That is my question.
Okay, I think higher contribution to retirement savings.
Higher contribution to retire, so you can inflate it. Abi?
Yes. No.
So when it inflates it, what will happen?
If the contribution to pension is higher, the amount to be paid as tax will reduce.
Will reduce. Okay, so if the contribution to pension is higher, the cost has increased, Abi? Expenses
Yes.
have increased, Abi, thereby
Yeah.
reducing the gross profit in which will be used in computation of tax, and thereby reducing the tax liability. Abi?
Yes.
Clap for yourself. You got it. Okay, great, Johnson.
Thank you.
Let me hear from you.
Hi, you were talking to me earlier, but I was not in a place where I could talk.
Okay.
So I think one of the variables in the income statement that the business could use to lessen their tax liability is their cost of sales. Yeah,
Cost of
because
sales.
yes, I think when it is overstated,
Hmm.
it reduces the gross profit, and
Okay.
then ultimately, when expenses are deducted from the gross profit, it's kind of also has an effect on the final profit that will be reported.
Okay. All right. That's a good one. But hold on. Let me please. Let me.
Bro. Hold on.
Hello, are we there?
Yes, sir.
Yeah, sorry for the network issue. So I was trying to ask some questions about how taxpayers can use very different variables to lessen their tax liability. Great, I've made some good contribution. Then Domade also make some good contribution. So let's move ahead. We've talked about cost description. So cost objective. The cost objective, the aim of this course is to enable candidates to have the knowledge and skill of identifying risky areas. To be able to identify risky areas, the examiner can give you a set of financial statements and what has happened, the client documents, vis-a-vis the financial statements. So you should be able to compare the two and also identify areas of high risk that may occur. I mean, in client in client tax filing and so on. So that is one of the areas you should be able to get to know. Right. So you need the skill that will enable you to identify the risky areas in tax audit and investigation, such as financial misstatements. There might be financial misstatements, even in the course of carrying out tax audit, you can find out that there was a misstatement in the financial statement. Then you can also find out tax evasion and tax avoidance schemes and mechanisms to counter them. So in the course of investigation that you can identify financial statements can also find the hello. I hope you guys are hearing me loud and clear there.
Yes, sir. Yes, sir.
Okay. So you should be able to, at the end of the course, not only identifying tax evasion and tax avoidance scheme, you should also provide mechanism to counter them. Then you should be able to explain the concept of tax audit and investigation. Then identifying differentiating features of the two concepts, that is tax audit and tax investigation. Be able to differentiate the features of the two concepts. Then you should be able to discuss tax audit and investigation principles. Explain the process for planning tax audit and investigation. To be able to explain to the examiner the process for planning tax audit and investigation. Yeah, hello, are we there?
Yes, sir.
Okay, so explain the concept of audit and investigation, identify differentiating features of the two concepts, discuss tax audit and investigation principles, explain the process for planning tax audit and investigation, then describe the process for controlling and recording tax audit and investigation. You as a tax auditor should be able to describe all this, describe the process for controlling and recording tax audit and investigation, explain interviews techniques, to be able to know interview techniques for tax investigation. Then you should be able to explain the determination of audit evidence, tax audit evidence, and understand audit techniques and procedures to be carried out so that you'll be able to unearth or discover or unveil any tax avoidance scheme or tax evasion scheme deployed by the taxpayers. You should be able to describe risk-based audit approach, then explain statutory powers of tax auditors and investigators to know the statutory powers of tax auditors and investigators, then describe tax audit procedure and risk assessment, tax audit procedures and risk assessment. That is the course objective. Then for course outlines, we have broken it into 12. We will have like 12 weeks classes that would take care of the diet before your exams in October. So weekly topics today, we are already handling introduction to audit and investigation. That is for week 1. Then the next week, we'll take on tax audit investigation principle. Then the third week, we'll still repeat because we might not conclude tax audit and investigation principle. We'll still repeat it in week 3. Then week 4, we look into planning of tax audit and investigation. Week 5, controlling and recording and audit investigation. Controlling and recording and audit investigation. Then 6, to repeat that, to continue from that, controlling and recording and audit investigation. Then 7, interview techniques. Interview techniques. 8, audit evidence techniques and procedures. For week 8, then we'll repeat that in week 9, audit evidence techniques and procedures. Then week 10, we will talk about risk-based audit approach. Risk-based audit approach. 11, statutory powers of tax auditors and investigators. Statutory powers of tax auditors and investigators. Then with 12, tax audit procedures and risk assessment. So after week 12, we can take on a revision class. We take on a revision class, an exam boot camp before your exam. So that is how the proceeding will go in this diet so far. So do you have any questions so far before we move ahead? Any question? No question, okay. Okay, let's go move to the meaning and objective of auditing and investigation. Most of tax system relies on self-assessment. The tax authority has substantial audits and investigative powers to ensure compliance. Both powers aim at ensuring correct amount of tax are reported and paid. These powers are of two types, the civil audit and tax criminal investigation. So tax audit is a civil matter. It's a civil matter, but when it comes to investigation, it's a criminal matter. So in the course of carrying out a civil audit, you can stumble on an act of a taxpayer that can warrant investigation. So when you launch deep into the investigation, it has now become a criminal matter. And when you lay hands on evidence that you can use to prosecute the taxpayer, so it has turned to criminal investigation. However, the line between the regulatory audit and criminal investigative powers is not always clear, which can lead to unpleasant surprises. However, tax evasion is a more serious exercise associated with heavy penalties and financial implications than tax audit. So take note of that. So the main difference between tax investigation and tax audit is that tax investigation will only be carried out based on having precise and definite evidence that the taxpayer has deliberately tried to avoid paying tax or has committed an act of willful evasion under the tax law and regulation. While tax audit just a normal routine, it's just a normal routine inspection on a taxpayer's operation, financial record, and other supporting documents, which substantiate the position taken in the tax return without any suspicion. So tax audit is just a normal routine. Then the objective of tax investigation are to ascertain the persons who are responsible for the offense and to verify and assess the correct amount of tax that has been paid. It is also aimed at creating awareness to the taxpayers and public on the consequences of not complying with the tax laws and regulations, and at the same time encouraging voluntary compliance. So that is what tax audit can do. Then tax investigation is not like tax audit, whereby taxpayers are given notice when it comes to tax investigation, taxpayers are given notice in advance that tax officers will visit their office. Tax investigation is carried out by the officers making surprise visits to the taxpayer. This is after you might have carried out background investigation and get some leading evidence that you can use to taxpayers' business premises and residents, agents, representatives, and various third-party premises to take possession of the required documents and books of accounts for investigating purposes. Tax officers will first introduce to the taxpayer and explain the purpose of his or her visit. So still on meaning and objective and auditing and investigation, tax officer will first introduce to the taxpayer and explain the purpose of his visit. The tax officer will usually show their ID card or a means of identification bearing their names and photographs. Tax officer will always inform the taxpayer the period of the year to be investigated and conducting the search for documents. During the investigation, the tax officer will make interviews with the taxpayers and other relevant persons and will inquire about possession of records or documents relevant to the investigation. The tax officers will make a written acknowledgement on the document taken. After taking the document, the tax officer will examine the record, especially on the transaction which are suspected to be false or that with effect of evasion. The taxpayer has the right to be represented by a tax expert who will attend the interviews and discussion on behalf of the taxpayer. If the taxpayer fails to give explanation and supply documents to prove the genuineness of the transaction, the tax officer will adjust tax computation, and additional assessed tax and impose penalty. Please, did you get my explanation?
Yes.
Okay. So if you have any doubt, anywhere you don't get the understanding, please, you can draw my attention. Please. We are trying to lay a foundation for So still on meaning and objective of auditing and investigation, another difference is that tax investigation of private companies may extend to cover directors' personal level. The directors may be requested to prepare capital statement, what's called capital statement. This is a list of his assets and liabilities. That's on a personal level now, and their living expenses to compare against all income of taxpayers. If there are any substantial discrepancies and directors fail to explain where they derive from, then the case may be considered as unreported income. In such a situation, the tax officers will adjust personal tax computation, that is personal income tax, and additional tax assessed and penalty be imposed. The penalty always depends on the time taken to carry out the investigation. The longer the time of investigation, the higher the penalty to be imposed. So the other difference between tax audit and tax investigation can be expressed in terms of time to undertake the assessment. In most cases, there is a limited time in tax auditing, unlike the tax investigation, whereby it can only be terminated when there is insufficient evidence to make a strong case against the suspect or no criminality involved, and in case of death or insanity of the suspect. So I'll give you a short diagram here explaining the rationale for tax audits. Why should we carry out tax audit? When we start from the base, you can see that in the far right, you see attitude to compliance. Far left, the attitude to compliance of the taxpayer. Then compliance strategy. Compliance strategy by my far right, that one has to be implemented by the tax authority. Tax authority. So when you move to attitude to compliance, when the taxpayer is willing to do the right thing, when the taxpayer is willing to do the right, if you have the attitude to do the right thing, what the tax authority will apply, the strategy they should apply is taxpayers' education. They have to educate the taxpayer, put pressure on him or her via education for him to pay. So the tax authority should make that easy, to make the education of the taxpayer easy so that we'll be able to pay because he's already willing to do the right thing. Then when you move to another attitude, when he's trying to comply but don't always succeed, the taxpayer try to comply but don't always succeed, what the tax authority should do is to assist the taxpayer to comply, assist the taxpayer to comply. And what should they do to be able to help him to comply in filing returns and face vetting? You should, encourage the taxpayer to file the return because he's trying to comply, but he is not succeeding. Maybe he's filing return, he's not filing it well. So the tax authority should be able to assist in taxpayer filing the return and face vetting, be able to vet his returns for him or her. Then if you move up the ladder, you see that the taxpayer does not want to comply. So if the taxpayer does not want to comply, what the tax authority do is to carry out tax audit. Tax audit. And what will be the outcome of tax audit? Deter by detection. Deter the taxpayer by detection. So put on your full armor of detection to be able to gain proof or gain evidence that you will use to deter the taxpayer. When you move to the top of the pinnacle, you will see that the taxpayer have decided not to comply. He have decided this one is a stubborn person, a stubborn level, he doesn't want to pay at all. Then at that point, you carry out investigation. For you to find out what is this taxpayer hiding. So at this point in time, it's not by deterrence, you use force of the law. The relevant tax authority uses force of the law to really enforce the law on the taxpayer to comply, and he might go to jail as well. So still on the meaning and objective of audit and investigation, an audit is an official inspection of an entity's personal organization account, systems or process played by an authorized and independent body or person to ascertain inherent risk, compliance with set standard and obligation. Where such an assessment is focused on the review of financial records, books and accounts, it is referred to as financial audit. While any focused existing system or process is called system audit. You should be able to know different types of audits. Financial audit has to do with the financial segment, has to do with books of account, record of account, and so on. That is financial audit. But when it's focused on the existing system, maybe IT procedures, IT system, maybe operational procedure, we are now talking of system audit. So financial audits are done on check. Financial audits are done to check if there are irregularities in an entry in accounting and operation, and to ascertain its financial standing. While a system audit is conducted to ascertain inherent risks that might affect an entity operation. I told you the system audit is operational risks, IT risks, and so on. So audits are also conducted as part of the tax assessment process, especially where taxpayer compliance is considered poor. I've viewed the pyramid of tax compliance in our last slide. And more especially, they are conducted for the following reasons. These are reasons why tax audits are conducted: to check the returns turned in by taxpayers, to check the return, the tax return turned in by taxpayers, to ensure the right assessment is raised and the correct amount of tax is collected. Then 3, to address non-filing of tax return, to address non-filing of tax return. So those are the reason why tax audits are conducted. The reason can be more. Do you have any other suggestion why tax audits are conducted? Do you have anything to add to that? Anything to add? Okay, so nothing to add. We are still moving. In the context of tax assessment, an audit can be defined as the examination of entities, person, organization, tax return, and sometimes underlying financial and non-financial record by tax authorities to ensure that the entity's income declaration and deduction claim are accurate. However, tax investigation may be carried out where fraud and deliberate false declaration are suspected. An investigation is much more detailed than an audit. While some of the techniques adopted in audit and investigation may be same, investigations are conducted with the intention to legally prosecute. When you carry out tax investigation, the end point is for you to prosecute the taxpayer or sanction more severely the concerned entity. The taxpayer can be individual, it can be an entity. So still on the meaning and objective of auditing and investigation. We need to define an audit itself, because when you talk of tax audit, you need to know the general meaning of audit before you can now relate it to tax audit, because there are different types of audit. There might be a system audit, there might be a tax audit, there might be all manner of audit. But if you don't know audit in general, you won't be able to relate to whatever audit that you are doing. So auditing is the process of examining a set of accounting books, record, vouchers, documents, information, etc., with the intent of establishing its reliability. The process is usually performed by someone other than the preparer or user of the information. Regardless of who is performing an audit, an internal or external auditor, the audit has the same purpose: to ensure that the financial statements as a whole are free from material misstatements. So from the definition, it can be deduced that auditing is the process of assessing the financial statement of an organization or association to which the person undertaking the task is not a member, with the aim of ensuring that these financial statements were truly prepared from the actual record of financial events and that the statement truly represent the financial position of the organization. So the auditing standard define auditing as the independent examination of an expression of opinion on the financial statement of an enterprise by an appointed auditor in pursuance of that appointment in compliance with any relevant statutory obligation. The auditor's responsibility is to report and give his opinion on the trueness and fairness of the financial statement as presented by the management. An audit is a process whereby the accounts of business entities, including limited companies, professional firms, etc., are subjected to scrutiny. Such detail as well as enable the auditor to form an opinion as to the accuracy, truth, and fairness. This opinion is usually presented in an audit report addressed to those who appoint the auditor, usually the shareholder. So that is the audit process, the normal audit process. So objective of audit will include to examine the internal controls, to ascertain that the check on and maintain the accuracy of business data, safeguard the company's asset against fraud, embezzlement, and theft, promote operating efficiency, encourage compliance with existing company policies and procedures, to ensure all necessary corrections are done, to obtain reasonable assurance, to express opinion in accordance with auditor's findings, to ensure all acquisitions are properly authorized, to ensure that the depreciation policy is appropriate, to ensure that all disposals are properly authorized and proceeds are properly accounted for. So all these activities will help the tax auditor to find out, because when you dispose assets, it warrants taxation. When you dispose assets, it warrants taxation. When you calculate depreciation on an asset, it warrants taxation. Because the taxman would not consider you as depreciation. Some companies use depreciation a lot to really enhance or reduce their tax liability, as per the question I asked earlier on. Then acquisition of asset also warrant taxation, and so on and so forth. So if all these things are not properly understood, you as a tax investigator or tax auditor, you will not even know what to do. So you get to know all this background first before you can apply it in your audit. So we move to merits and demerits of auditing and investigation. Merits and demerits of auditing and investigation. Auditing serves as a deterrent to fraudulent staff within an enterprise. During amalgamation or acquisition, auditing financial statements serve as a basis of determining the purchase consideration of a part to be acquired or amalgamated business. So when you audit the asset, and you know that the asset exists, it's from the basis of purchase consideration. That is the price money that you will pay for that company to be acquired. So audit can enhance that. Then audit financial statement can be used to negotiate bank loan. Can be used to negotiate bank loan. We are talking of merits of auditing. So a financial statement examined independently by an auditor will be really accepted by the tax authority for the purpose of taxation. So one of the documents of the tax auditor is audited financial statement. So the tax auditor can rely on that piece of information. Then audited financial statements serve as basis for measuring performance by the world to be potential investors. As another merit. Audited account is one of the requirements of the Nigerian Stock Exchange for a business that is willing to be listed in the Nigerian stock market. Then audit facilitates the provision of advice that can have real financial benefits for business. So auditors can act as advisory, or audit opinion can act as an item of advisory to the entity being audited. So take note of audit. Those are the merits of audit. Then we move to the merit of auditing. It is not the responsibility of auditor to make recommendation, hence auditor cannot perform the following. They are less concerned with the management policies. Not that they are less concerned, it's not their duty. They are not policymakers of the company, they are just consultants. They cannot guide management for better use of capital. It's not their role for that. So auditing fee is seen as additional expense to a business enterprise because most of these firms, when you finish their audit, as if you are a financial auditor, not tax auditor now, you are a financial auditor, you find it difficult to collect your audit fee because owners of business, they think that you don't do anything. The auditor does not do anything, just to come and examine the books. And they are seeing it as an additional expense on them. So audited financial statements, if qualified, could lead to liquidation of enterprise even where there is a solution side. So these are the merits. Then auditing with the enterprise will lead to management shareholders conflict. Because if an auditor wants to stand his ground, he will bring conflict between the management and the auditor. The auditing could be time-consuming as the time being used on productive matters by members of the company. Yes, for large companies that you have a lot of things to audit, it can be time-consuming, if not for modern way of doing audit now, automation, artificial intelligence, data analytics, and so on. So that's where we are. Qualities of an auditor and investigator. Qualities of an auditor. The auditor must have the required experience. You must have a required experience academically and professionally qualified. That's why you want to acquire CITN certification. The auditor must have a mindset that recognizes different business needs. Knowledge and experience such as auditor must be knowledgeable and technically sound on the company's law. You must know the company's law, that is Company and Allied Matters Act, CAMA, 2020 as amended, accounting, auditing, information technology, and other related subjects. You must know them. Conformity with confidentiality principle. Auditor must not disclose information about his client to the third parties except where the permission to do so has been granted. Those are the qualities. It can be more than that. You can read more on your own. So independence and objectivity, intellectually honest, free from any obligation or interest. These are other qualities. Ability to make independent decisions, must not be biased, must be dependable. Auditor must be open-minded, fact and effective communication skills, intelligence, clear thinking, and capacity for dealing with new problems with energy, initiative, and imagination, so as to be able to devise workable solutions. Personality and a reputable temperament, integrity. An auditor must be honest and to be seen honest in the implementation of audit assignment. These are qualities of audit and investigator, auditor and investigator. Now, these are other services an auditor can provide. You can writing up books. You can write up books of accounts, balancing books of accounts, preparing final accounts, filing returns to government offices, tax negotiation. So auditor, tax auditor, auditor as a person, as a career person, can act as a tax negotiator, can file returns on behalf of his client, can prepare final account, can balance book, can write off books. So those are services for that. Other services are investigation, can carry out investigation, can do tax planning, financial advice, management and system advice, liquidation and receivership work, liquidation and receivership work, risk management, processing and obtaining tax clearance certificates, processing incorporation certificate for their client. So you can do all that. So before we move to fundamental principle of auditing, do we have any question to ask? Any contributions so far? Are you enjoying the class?
Yes.
Yes, sir.
Okay. So let's look at fundamental principles. These are fundamental principles of auditing. There are 5 fundamental principles in auditing code of ethics and conduct. These are set out below. We talk of integrity, objectivity, professional competence, confidentiality, then professional behavior. Let's take them one after the other. Integrity, professional members must be straightforward and honest in all professional business. Relationship integrity implies not just honesty, but also fair dealing and truthfulness. Objectivity, professional members must not allow bias, conflict of interest, or undue influence of others to override their professional or business judgment. So you should not allow the taxpayer to influence you or your client as an auditor to influence you. Professional competence and due care. Members have a duty to maintain their professional knowledge and skill at such a level that a client or employer receive a competent service based on current development in practice, legislation, and techniques. Members must not diligently and or in accordance with applicable technical and professional standards. Confidentiality. Professional members must respect the confidentiality of information acquired as a result of professional and business relationships and must not disclose such information to third parties without authority or unless there's a legal or professional right or duty to disclose confidential information acquired as a result of professional business relationship must not be used for professional advantage of members or third parties. So that is confidentiality for you. Then professional behavior. Professional members must comply with relevant laws and regulations and must avoid any action which discredit the profession. They must behave with courtesy and consideration towards all with whom they come into contact in a professional capacity. So these are fundamental principles of auditing. Then other principle is talking about professionalism, professional judgment, clear communication. Then you have to also provide value to your client. So after the audit, have you added value to the client? Not just to go and look at books. So after finishing your audit, you should be able to leave the client better than you met the client. So we move to concept of expectation gap. Does anybody knows something about expectation gap? Who can tell us? Have a short knowledge or a little knowledge about expectation gap. Have you heard this kind of expression before? Have we?
Expectation gap. I think I have an idea.
Okay, go
Maybe
ahead.
when the auditors, or maybe the person you're auditing has a different perspective from the auditor. Maybe
Okay.
yes, maybe they have different expectations, different belief or ideology about the duties and responsibilities of or the messages. Yes, or the auditor, or the message conveyed by the auditor, something like that.
Okay, you have an idea. That is Ambrosia, Abi?
Yes.
Okay. So, expectation gap, the expectation gap, the definition is that the expectation gap in auditing is defined as follows. The difference between what the public and financial statement user believe auditors are responsible for and what auditors themselves believe their responsibility are. This is ISPA 1993, Association of International Certified Public Accountants, ISPA. So the difference between what an auditor actually does and is required to do by legislation and auditing standard and what stakeholders and commentators think that the auditor's obligation might be and what they might do. This is ICAN, according to IQ. IQ is a Institute of Chartered Accountants of England and Wales. They are the one that defined this one in 2018. So this is a kind of gap. What the auditor expects, what the auditor knows that his responsibility is different from what the stakeholders think that the responsibility of the auditor is, and thereby creating a gap. There's a gap in between the 2 or 3 groups of people, the owners of the company, the auditor, and the public. So they think differently what the responsibility of auditor is. So that is what brings about the expectation gap. What they expect from the auditor is not what the auditor thinks that his responsibility are. A simple way of explaining expectation gap. As Ambrosia said, he was correct in a way. So expectation gap, you have 3 different levels of expectation gap. There's a knowledge gap, there's performance gap, and there's a evolution gap. So knowledge gap is what the public think auditors do, because the knowledge gap is different. They don't know what actually is the duties and responsibilities of the auditor, thereby creating the knowledge gap. Then performance gap is what auditors actually do. What auditors actually do. So the job carried out by the auditor, does it meet the standard? Does it meet the standard? That one comes about by performance gap. Then we now talk of evolution gap. What auditors are supposed to do, what auditors are supposed to do, and what the public wants auditors to do. That difference creates evolution gap. So take note of that. That's audit expectation gap for you. So expectation gap, we said that knowledge gap is the difference between what the public thinks auditors do and what auditors actually do. This recognizes that the public may misunderstand the role of auditor and the requirement of the auditing standard. The public does not know the requirement of the auditing standard, thereby not knowing the role of the auditor. Then performance gap, where the auditor do not do what auditing standard or regulation require due to the complexity of the auditing standard. That is unclear requirement. Difference in interpretation of auditing standard or regulating requirements between practitioners and regulators. So this can create performance gap. there are some auditing standards or accounting standards that are very complex, thereby bringing about a judgmental attitude of the practitioner to play. So the auditor now falls back to professional judgment in implementing those standards. So this complexity of standard can create performance gaps. So at the end of the day, what outcome or the output of the auditor might not meet up what the owners of the business expect because of this complexity of interpretation of all these standards or an application of all these standards. So what the regulators expect might fall short of what the auditor actually carried out. So that is where you have the performance gap happening. So evolution gap, area of the audit where there is a need for evolution, taking into consideration the general public demand, technological advance, and how the overall audit process would be enhanced to add more value. So in this area, you know, audit works by sampling size. They work by sampling documents. They don't carry out 100% vouching. But as the time goes by, now we are talking of artificial intelligence that can vouch the whole document, that can scan through the whole document in a few seconds. We talk about data analytics. We talk about blockchain technology and Internet of Things, and so on. We talk about audit software and so on. So these are the evolution gap. So they expect the auditor to carry out 100% vouching, but auditor is constrained not to carry out 100% vouching. So when the auditor come out with the opinion that he was doing sampling size, the stakeholders might say there's a lot of technology that can make you to vouch 100%. So what are you complaining? What are you talking about? But the standard has not been amended to fit in the reality of time where vouching can be done 100%. So that is evolution gap that have been created. So let's move ahead. Do we get the understanding? Do you get my explanation here? Hello, do you get my explanation?
Yes, it is understood.
Okay, all right. So still on the concept of expectation gap, we talk of auditors' responsibility according to ISA 200. ISA is International Standard on Auditing. So the purpose of the audit is to enhance the degree of confidence of the intended user in the financial statement. This is advised by the expression of an opinion by the auditor on whether the financial statements are prepared in all material respects in accordance with an applicable financial reporting framework. So in the case of most general purpose financial statements, case of general purpose framework, that opinion is on whether the financial statements are presented fairly in all material respect or give a true and fair view in accordance with the framework. An audit conducted in accordance with ISA, that is International Standard of Auditing, and relevant ethical requirements enable the auditor to form that opinion. So auditor's responsibility is to form an opinion on the financial statement. So based on the framework that he has used in conducting the audit. So the financial statement objects to audits are those of the entities prepared by management. So the financial statement subject to audit, and the subject matter of the financial statement, is not the responsibility of the auditor, but that of the management is prepared by management of the entity with oversight of those charged with governance. Those charged with governance are the audit committee. So ISA do not impose responsibility on management or those charged with governance and do not override laws and regulations that govern their responsibilities. However, an audit according with ISA is conducted on the premise that management and where appropriate, those charged with governance have acknowledged certain responsibilities that are fundamental to the conduct of the audit. So the audit of the financial statements does not relieve management, those charged with governance, of their responsibility. So their responsibility is to prepare the financial statement. So at the basis for the auditor's opinion, ISA require the auditor to obtain reasonable assurance. Reasonable assurance because he's not taking up 100% vouching. He's doing sampling vouching about whether the financial statements as a whole are free from material misstatement, whether due to fraud error. Reasonable assurance is highly level of assurance. It is obtained when the auditor has obtained sufficient and appropriate evidence to reduce audit risks, that is, the risk that the auditor expressed an inappropriate opinion when the financial statements are materially misstated to an acceptably low level. However, reasonable assurance, not an absolute level assurance, because it's not doing 100% vouching, because there are inherent limitations of the audit, which results in most of the audit evidence on which the auditor have conclusions and basis, the auditor's opinion being pervasive rather than conclusive. So this is what the ISA talks about the auditor's responsibility. These are the management responsibility. So when we talk about the role and responsibility of external auditor, laws and regulations such as CAMA 2020, BOVIA 2020, etc., require audit of financial statements. The laws require audit of financial statements. Audit of financial statements should be performed in accordance with the professional standard. Be performed with professional standard, that is ICAN, International Standard Auditing. Audit is performed based on selection of sample. I've already said that, for testing rather than the entire population of the transaction that occur during the period. That is ISA 530, audit sampling. Audit of financial statement is different from forensic audit. Auditor's responsibility in relation to fraud or an audit of financial statement are specified in ISA 240. Auditor's responsibility for assessing entities' ability to continue as going concern. Going concern, that is, that entity will continue to be in business. That is what International Standard on Auditing 240 stipulates. It is clearly specified in ISA 570 again, that is changes made to expand the scope of audit reporting by reviewing ISA 700, which become effective in 2016. So those are role and responsibility of external auditors. Sorry for the interruption. Are we still there? Are you hearing me?
Yes.
Okay. So we are still talking about I say seven auditors rules regarding other information in annual report. We'll be talking about CAM. CAM are matters that in the auditor's professional judgment are of most significance in the audit of the current period financial statement. Auditors' responsibilities regarding other information in annual report are specified in ISA 720. So regular inspection by audit regulators, example, Financial Reporting Council and ICAN to close performance gap. Introduction of international standard for quality management, one, to close performance gap. So these are the role and responsibility of external auditors. So we continue. So still on the concept of inspection gap, areas of audit which highest percentage of findings by audit regulators based on the report of the International Forum of Independent Audit Regulators, IFA 2017, are accounting estimates, including fair value measurements, internal control testing, audit sampling, group audits, revenue recognition. So we are talking of where areas that can bring conflict, that can bring undue expectation, which can create gap. Example of such areas of high risk areas, accounting estimate. Example, how do you arrive at the depreciation rate? How do you value your assets? Then internal control testing, then audit sampling. What is the sampling size that you are using to arrive at your opinion? Then group audit is a complex audit. Then revenue recognition is another contentious area. So closing the expectation gap and the public trust issue. How do you close this gap? This gap that is having, that the auditor have, the stakeholders have, the government have, and every other stakeholders are having different expectations. So how do you close the gap? So key stakeholders closely connected to the audit profession, such as regulators, standard setters, professional accountants bodies, audit firms, audit committees, investors, government, media, the general public need to collaborate to address knowledge and performance gap. Closing the knowledge gap. Audit firms and professional accounting organizations should develop strategies for improving communication of any update to the existing audit requirement to the public using wider reaching platforms such as social media. So the general public should be educated of the auditing regulations or auditing regulatory standard so that they will know what is expected of an auditor. So another one is that regulators and standard setters should inform the public about any changes to existing audit regulation or standard, including rationale for those changes. Another one is that media should try to describe audit requirements to the public as accurate as possible when reporting on the profession. So take note of this, closing on the gap. Still on closing the expectational gap and the public trust, effective implementation and operation by audit firms of ISQM, the International System of Quality Management, one, which become effective on 15 December 2022, will effectively help in closing the gap. Audit firms should ensure that audit quality is achieved and maintained through understanding and reacting to areas of resistance, low performance. Then audit regulations should support innovation by audit firms to enhance audit quality and avoid instilling a box-ticking approach. Then standard setters should be responsive to audit quality issues by updating standard and providing implementation support. These are where those expectation gap can be closed. Still on closing the expectation gap, policymakers should be mindful of the link between the knowledge and evolution gap components when implementing new policies and regulations to satisfy public demand. Some believe auditors should have more responsibility in identifying and reporting fraud or preventing company failure. Further research is needed in this area. There is a need for more detailed research to understand the connection between the knowledge gap and the expectation around the evolution gap. So, who are the audited account users? Who are the audited account users? You have the shareholders, the creditors, government and other authorities, investors, regulators, employees, debtors, general public. Those are users of government accounts. Then the expectation of the audited account users. The shareholders wish that the accounts should be examined by an independent and competent person who must assess and attest on the account on how well management have discharged the function. That is what the shareholders think the auditor should do. They believe an auditor is to be blamed in the event of company liquidation, which has been audited by the auditor. So is auditor to be blamed in the event of liquidation of a company? Is auditors to be blamed? I'm putting the question to you.
In my own opinion, they should be blamed partially because they are meant to, yes, they are meant to follow up with the activities of the company and advise when the company is doing something that is not profitable.
Okay.
So if they are not reporting the correct picture of the organization, certainly they should be blamed when the company fails. Like the company is not making profit and they just decide to report that, okay, the company is doing well.
Okay.
Something like that.
So they should be blamed 100% or partially, as you said.
Well, I would say partially.
Okay.
Yeah.
Okay. So another expectation auditor account users is that where adequate supply of needed vital and crucial information document is not provided by the management of the company to the auditor sue such management. So the users of the auditor account believe that external auditors deliberately keep useful secrets of audited companies from them due to over-dependence on auditors' opinion. The users of the audited account believe auditors' opinion on the financial statement of the company for a year they should be able to rely upon for the subsequent years. The users desire that auditors present audited account in such a way that it will be easily understood by users, and the issue of misconception on the duties of an auditor or misinterpretation of accounts will not arise. The user also believes that auditors should give absolute assurance and not just a reasonable assurance on the audited account. This last one is where the major contention is, giving absolute assurance. But the auditor will not accept that, will not agree. The auditor will not agree to give absolute assurance. So why do you think that the auditor will not agree to give absolute assurance in the audit opinion, in his audit opinion? Why do you think so?
Because if anything should go wrong to eventually, they will put the whole blame on the auditor because he has given assurance.
They have given.
Because he has given assurance at the beginning, if any bad thing happen eventuality, they will put the blame on the auditor. So that's why auditor always give you a disclaimer.
Okay, but okay, I understand now. But do we know the thin line between absolute assurance and reasonable assurance? We understand the thin line in between.
Absolute assurance should be 100% quality.
Okay, all right. Thank you. So one of the reasons they cannot give that is because they are doing sampling size. They have not looked into all the documents. They just sample size it and base their opinion on that. So something that you sample size, you cannot come and give absolute assurance on it. So it must be a reasonable assurance. So let's move to management responsibilities. To run the company effectively, efficiently, thereby safeguarding the asset entrusted on its scale, preparation of financial statement free from material misstatement, rendition of audited accounts to the shareholders at regular intervals, usually on an annual basis, disclosure of financial statement of the company with reasonable accuracy of all times, ensure that established controls are strictly adhered to, maintenance of proper books, transaction, ensure that accounting books and record of the company are kept at the company's registered address, ensure internal control procedure are instituted to safeguard assets, present and detect fraud and other irregularities, continually update existing control to block any discovered loophole, study the business environment and recommend improvement on review of existing controls, maintaining internal control, assessing efficiency of business operation. However, effective internal control and system assist management on performing the task well. So these are management responsibility, owners of the business. So we look at how to differentiate between tax auditor, tax audit, and statutory audits. How can we differentiate them? So we have internal auditing, internal auditor in one, in another, then tax auditor in another hand. So internal audit is an employee of the firm. Statutory auditor is an external body firm. So that is different. Tax auditor is an employee of the federal government, that is IFRS or state inland revenue service, any of the two. Then the management of the organization determines the work undertaken by the internal auditor. The statutory auditor works according to the rules and regulations of the Companies and Allied Matters Act and other regulatory documents. Then the tax auditor, and the tax audit is carried out to enable the tax auditor to ascertain whether the taxable person has complied with the provision of the relevant tax laws. Those are the differences. Then when you talk of internal audit, in terms of internal auditor would examine issues related to the company business. The external audit examine the financial statement. Then the tax audit determine the correct amount of tax payable in accordance with the inherent relevant tax law, statement, rule, and regulations. So that is what the tax auditor does. Then the internal auditor, the external auditor, examine the financial record and to produce a report representing his opinion on the truth and fairness of the financial statement. Then internal auditor issues handle issues related to company business, then practices and risk. Then internal audit in terms of carried out internal audit in terms of duration or frequency, it is carried out throughout the year. Then external auditors conduct a single annual audit once in a year. Then the Corporate Affairs Commission, CAC, EVA-RS, and others require companies to file their tax annually, to submit their audited financial statement to them on a yearly basis. When you talk of internal audits in terms of they are hired by the company, then the statutory auditors are appointed by the shareholders, then the tax audit is at the instance of the management of the relevant tax authority. When you talk of internal audit, it does not necessarily have to be, the statutory auditors must be qualified, must be a qualified person. Then for tax, there is no provision for qualification. For tax auditor, there's no provision for qualification. So internal auditors, they are responsible to the management. The statutory auditors are responsible to stakeholders. Then tax auditor responsible to the relevant tax authority. Internal auditors can issue their findings to any type of report format. They have their format, any format at all. The statutory auditors are responsible to, statutory auditors they have a more specific template format for the audit opinion and management letters. Then tax audits issue report based on the format of the relevant tax authority. Internal audit reports are used by management. Statutory audits are addressed to members of the shareholders of the company. Tax audit addressed to management of the relevant tax authority. Statutory audit, relevant tax authority. So internal audit can provide professional advice and other consulting assistance to employees. Statutory audits are legally constrained from supplying or advising the client. Then internal audits are to provide necessary materials for the auditor, preparation of financial statements, and the audit will enable the firm to form an opinion, that is for statutory audit, as to whether the taxable person has maintained books and record. That is to the essence of the tax auditor. An effective system of internal control that has to do with internal audit, then to examine whether the internal control and to are in place and to ascertain that they safeguard the company's asset against fraud, embezzlement, or theft. That is what the external auditor will do. Tax, determine tax accordance with the relevant tax laws. So when you talk of external audit, you talk of the rights, the powers. The statutory auditor are governed mainly by the provision of the Companies and Allied Matters Act. I've mentioned that earlier. So you should be able to differentiate these different types of auditor, the internal auditor, the external auditor, and the tax auditor. Very beautiful question can come from there. Examiner can dazzle you with that. So go and lay your hand on materials and study it. So when you talk of external auditor, you should be able to discuss external auditor in terms of qualification, in terms of appointment, in terms of the duties and responsibility of the external auditor, in terms of rights of an auditor, remuneration of the external auditor, removal of the external auditor, resignation, Then we have already talked of management responsibilities in our earlier slide. So when you are discussing external auditors, you should discuss them. You should know the following: under Company and Allied Matters Act 2020, qualification, appointment, duties and responsibility, rights, remuneration, removal, resignation. So that is what external audit is all about. Then when you are talking of internal auditing, you should be able to know the objective and purpose of internal audit, function of internal audit, internal control system, you should know them, purpose of internal control system, why internal control interests the external auditor, why the internal control interests the external auditor. Why does the external auditor put his interest in the internal control system of a client? Then characteristics of internal control system, practical aspect of internal control. So when you are discussing internal auditing, you should discuss them under this heading. When you are discussing external auditing, you discuss them under this heading. So you go and make more inquiry on that. Then let's move to investigation. An investigation can be defined as a thorough and in-depth examination of financial statements of an organization and their relevant supporting document for specific purpose of obtaining facts to evaluate specific situation to be submitted to an interested party. Investigation differs a lot from audit. We have already tackled this in our earlier slide. So a few of different, which are briefly explained below: objective of an investigation to determine what occurred in a particular situation so that the employer can take appropriate action to improve the work environment and financials or accounting system in order to meet any legal obligation that might exist based on the findings, to collect, analyze, and evaluate facts in respect of desired field of activity with a view to some special purpose as determined by the person on whose behalf the investigation is undertaken. So reasons that may call for investigation. Investigations are carried out under various circumstances, such as, so these are reasons why investigation can be called. It is conducted based on third-party information, petition, or whistleblower can call for it. It is carried out based on suspicions or suspicion. Then measures and accusation or amalgamation can bring about investigation. Then there is measures, accusation, and amalgamation of companies. To determine whether a fraud or error has taken place, investigation can be carried out to determine whether fraud or error has taken place. To determine whether royalty has been correctly established, it is carried out on the target on behalf of an entity proposing to acquire the target. So this is where investigation can be done. Then when we talk you can say investigation is objective. It is to establish a fact and evaluate specific situation on the examination of specific record, while auditing is objective to ensure that financial statements are not misleading or unreliable. An auditor is to express his opinion on the financial statement on the basis of sufficient evidence collected by examining the document and record. Then two, investigation. In investigation, the scope and objective are specific and narrow. Investigation have narrow objective, while all the scope and objective are general and broad. In investigation, substantive and conclusive evidence is required. In audit, persuasive evidence is sufficient for an auditor to form an opinion. In investigation, exercise is based on suspicion or special requirement. For audit, exercise is an annual statutory requirement. For investigation, is not carried out on the basis of accounting convention or rules. No standard of professional guidance on an investigation. But for auditing and assurance, standards are available. Investigation interrogatory nature, recognized. So investigation might be a one-off, while auditing is a routine. So qualities of an investigator. I gave you area on quality of an auditor. So you also have quality of an investigator. What are the qualities? It is important that the investigator and diligence, integrity, self-discipline, must be honest and be seen to be honest assignment. An investigation an investigator must not be biased or prejudiced. Here's another one, knowledge is required. Investigator must be ethical. Investigator must have ability to win confidence of people, must be very good at documentation, must be computer literate, obligation or interest, free from any obligation or interest. Investigation must have the required experience, academically and professionally qualified, ability to make independent opinion, conformity with confidentiality principle. Investigator must not disclose information about the subject of investigation to third parties except where the permission to do so have been granted, either by court or general public interest. So we've ended our class, but let's see how we can look into some questions here. We have overshoot our time is because we started a bit late. So as I said, discuss an auditor under the following edition of auditors, appointment of auditors, the duties and responsibilities of auditors, right of an auditor, remuneration of auditor, removal of auditor, resignation of auditor. So that is your takeaway question. You can lay your hands on the necessary materials and make the answers available. Then question 2, what are the likely difficulties an internal and external auditor will face while performing their duties? And how can these difficulties be overcome? Who can handle this before we close? Just quickly before we close, who can handle this question? Our time is fast spent. Can you do this in 1 minute? 9:49. Are we there? Okay, do you have any contribution to make? Any question, any contribution, any accolade, any part on the back before we close? Talk, let's close the class. Any appreciation, any part on the back, any question, any contribution, any disagreements, any query? Do we have? Or can somebody move the motion for us to close the class? Can somebody move the motion for us to close the class? To reconvene next week?
It was a quite a very interesting class, and I think I gained a lot of information in regards to this issue of auditing and the internal auditor, external auditor, and investigation. My own take is it was very interesting class. I don't know if there's a duration for whether there's a duration for internal auditor, maybe there's a standard operational procedure.
There's no duration. When we're talking about the differences, we said it's a continuous thing, it's a routine thing. It does not have duration. Because they are employee of the management, they are employee of the company. They resume there on a daily basis, so there's no duration.
Okay. Thank you very much.
All right. So on that basis, you can go and lay your hand on these answers. Maybe when we reconvene, we can tackle the answers together. So have a nice weekend and see you next time. Goodbye.
Thank you. Goodbye. Thank you very much.
Thank you, sir.